The crypto market just sent a shockwave across the financial world, and if you blinked, you missed it. Bitcoin slipped back toward the $67,000 level, momentum faded fast, and fear rushed in almost overnight. What looked like a recovery rally only days ago has turned into renewed selling pressure. And traders everywhere are asking the same question. Is this just a healthy pullback, or is something much bigger unfolding beneath the surface? Over the past 24 hours, Bitcoin has struggled to hold ground near the mid-$60,000 range after giving back a large portion of its recent bounce. Ethereum followed the same path, weakening alongside broader crypto markets as risk appetite cooled. The selling pressure did not happen in isolation. Global markets shifted into a risk-off mode, and crypto once again moved in correlation with equities, proving that digital assets are still deeply connected to macroeconomic forces. One of the biggest catalysts behind this hesitation is the strength of recent U.S. economic data. Stronger than expected jobs numbers reinforce the idea that the Federal Reserve may keep monetary policy tighter for longer. Investors are now waiting closely for upcoming U.S. inflation data, especially CPI figures, because any surprise to the upside could delay rate cuts. When interest rate expectations shift, liquidity shifts with them, and crypto is often the first asset class to feel that pressure. As Bitcoin hovered around $67,000 in Asian trading sessions, volatility remained elevated but directionless. Bulls attempted to defend key support levels, yet conviction appeared weaker than it did during the prior rally. Traders are cautious, not panicked, but cautious enough to reduce leverage and trim risk exposure. That shift in behavior alone can amplify short-term downside moves, especially in a market built on momentum and sentiment. Adding fuel to uncertainty, Standard Chartered issued a bold forecast that caught global attention. The bank projected that Bitcoin could potentially retrace toward $50,000 before finding stronger footing later in 2026. Ethereum, according to the same outlook, could fall toward the $1,400 level in a deeper correction scenario. While forecasts are not guarantees, when a major global bank publishes downside targets, it influences institutional psychology and risk modeling decisions. That forecast does not mean a collapse is inevitable. It reflects the possibility of continued volatility in a macro environment that remains unpredictable. Higher interest rates for longer periods reduce speculative capital flows. Liquidity tightens. Risk premiums rise. And assets like Bitcoin, which thrive on expansion cycles, can temporarily lose momentum. The question is not whether volatility will continue. The question is how deep it could go before buyers step back in aggressively. Meanwhile, another development raised eyebrows across the industry. Institutional crypto trading platform BlockFills reportedly halted withdrawals and restricted trading activity amid market stress. In any market environment, restrictions on withdrawals trigger immediate concern because liquidity confidence is everything. While details are still unfolding, the news alone reminded participants how fragile certain parts of the ecosystem can become when volatility spikes quickly. When platforms restrict withdrawals, even temporarily, fear spreads faster than facts. Traders begin questioning counterparty risk. Institutions reassess exposure. Retail investors grow nervous. It does not take a systemic failure to shake confidence. Sometimes all it takes is uncertainty. And in crypto, uncertainty often translates into aggressive selling as participants choose safety over speculation. Beyond individual platforms, broader crypto indexes have been trending lower alongside global equities. This correlation reinforces a reality many long-term believers once resisted. Bitcoin is increasingly behaving like a macro asset. When traditional markets de-risk, crypto de-risks. When bond yields rise, growth assets feel pressure. The narrative of total independence from traditional finance has evolved into something more complex and interconnected. Yet despite the pullback, this is not 2022. Institutional participation is significantly deeper. Spot Bitcoin ETFs, which changed the landscape in prior years, created structural demand channels that did not exist before. Long-term holders remain active. On-chain metrics show that many wallets are still holding rather than panic selling. Corrections inside broader uptrends are common, even necessary, to reset overheated leverage. The market right now feels tense, but tension does not equal collapse. It reflects indecision. Bulls argue that consolidation around $67,000 after a strong multi-month rally is constructive. Bears argue that weakening momentum combined with macro pressure could open the door to sharper downside. Both sides have data to support their case. That balance is exactly why volatility remains elevated. Another factor shaping sentiment is anticipation. Investors are waiting for clear direction from inflation data and central bank commentary. If CPI comes in softer than expected, risk assets could rebound sharply as rate cut optimism returns. If inflation surprises to the upside, markets may quickly price in prolonged tight policy, which could push Bitcoin closer to the lower targets projected by cautious analysts. What makes this moment critical is positioning. Leverage across derivatives markets had built up during the recent rally. As price momentum stalled, some of that leverage began unwinding. Liquidations accelerate price swings. They exaggerate both upward and downward moves. When traders are forced to close positions automatically, volatility compounds itself. That dynamic explains why recent price action has felt sharp and emotional. Still, beneath short-term turbulence, development across the crypto ecosystem continues. Network upgrades, scaling improvements, and institutional staking participation are expanding quietly in the background. While price captures headlines, infrastructure growth often tells a longer story. Historically, periods of doubt have also been periods of building. The market cycles between fear and confidence, but innovation tends to move forward regardless of sentiment. For investors watching from the sidelines, this environment demands discipline. Emotional reactions often lead to poor timing decisions. Markets rarely move in straight lines. Corrections can create opportunity, but only for those prepared with risk management strategies. Blind optimism is dangerous. Blind pessimism can be equally costly. Data, not emotion, must guide positioning. Right now, the data tells us this. Bitcoin is under pressure near $67,000. Ethereum is weakening alongside it. A major global bank sees potential downside toward $50,000 for BTC and $1,400 for ETH before possible recovery later in the year. A trading platform has restricted withdrawals amid stress. Macro uncertainty around U.S. inflation and interest rates is driving cautious sentiment. But the data also tells us something else. There is no confirmed systemic collapse. There is no evidence of widespread network failure. There is no regulatory shock announced today. What we are witnessing is a market reacting to macro pressure, liquidity concerns, and shifting expectations. That distinction matters. Crypto has survived deeper crashes, harsher headlines, and more severe liquidity crises. The difference today is maturity. Institutional players analyze risk differently than retail traders did in previous cycles. Capital flows are more structured. Transparency is greater. While volatility remains intense, the infrastructure supporting the market is stronger than in earlier downturns. The coming days will likely be decisive. Inflation data, Federal Reserve signals, and institutional liquidity conditions will shape direction. If confidence returns, Bitcoin could stabilize above key support and rebuild momentum. If macro pressure intensifies, the downside projections from major banks could gain credibility faster than many expect. This is the nature of crypto in 2026. Global, interconnected, reactive, and relentlessly volatile. Every headline moves markets. Every data release shifts expectations, and every correction tests conviction. Whether this moment becomes a brief pullback or the beginning of a deeper retracement will depend on forces larger than any single chart pattern. For now, the market stands at a crossroads. Fear is rising, but panic has not taken over. Support levels are being tested, not shattered. Institutions are cautious, not fleeing. And traders are watching closely, knowing that the next macro surprise could ignite either a powerful rebound or a sharper decline. One thing is certain. The calm optimism from earlier rallies has been replaced by tension. And in crypto, tension often precedes decisive moves. The question is not whether volatility will continue. It will. The real question is which side of this battle between macro pressure and long-term adoption will win in the weeks ahead.